What came through in the deliberations is that Governing Council's discussions about future policy is shifting from whether monetary policy is restrictive enough to how long to maintain the current restrictive stance.
Cautious optimism from the Bank of Canada as the nation's central bank keeps the policy interest rate at 5%. Governor Tiff Macklem says there's a consensus among bank governors that they want to keep the rate where it is for now, but says it's still too soon to talk about cutting rates.
When you look at the indicators, we've seen some progress, but that progress has been uneven. And as I said, we're concerned about the persistence in underlying inflation. And what that means is that it's premature to discuss reducing our policy rate.
Macklem says supply is now outpacing demand, good conditions for inflation to drop. But housing inflation remains at 7%, while food is at 5%. While bank governors say they believe high rates are working, Macklem says he knows that's not how it feels.
I think what's happening is Canadians are going shopping and they're seeing food prices are still rising 5%. They're seeing their rent is rising, 7-8%. So they're still feeling the effects of inflation.
They're still talking about the economy having been stagnant in the middle of last year. And the economy rose in the second quarter, but it dipped in the third quarter. And we think that that contraction is the start of the recession.
Tony Stilo of Oxford Economics thinks Canada may have missed the chance at a soft landing. If that's the case, Stilo says the bank might start cutting rates in June if they believe Canada is in an economic slide.
We're highly indebted and we have a heavy reliance on housing, two very interest rate sensitive sectors. And we think the past rate hikes are starting to really hit that sector of the economy. And with mounting mortgage renewals, we think it's reached a cresting point now.
In Ottawa, Xiaoli Li, City News.